Most people view a financial downturn as a period of inevitable loss and fear. However, the most successful investors understand that a recession is actually a generational wealth-building event in disguise. This shift in perspective is essential because when markets panic, asset prices often disconnect from their true fundamental value. Consider the global financial crisis of 2008, when veteran investors like Warren Buffett infused billions into established companies like Goldman Sachs. While the general public was selling in a frenzy, those with a disciplined mindset were securing favorable terms that yielded massive returns for decades to come. By training yourself to see a market correction as a clearance sale on quality assets, you position yourself to capture growth that others will miss. Understanding that volatility is the price of admission for superior returns allows you to remain calm while others are making emotional decisions. You must embrace the idea that the greatest fortunes are built during the most challenging times. The most critical asset you can possess before a downturn hits is a significant cash reserve, often referred to as dry powder. Having liquidity is the only way to capitalize on opportunities when they finally present themselves. Without cash on hand, you are forced to watch from the sidelines as prices drop, or, even worse, you might be forced to sell your own assets at the bottom just to cover living expenses. For instance, during the market crash in early 2020, investors who had maintained a healthy emergency fund and extra investment cash were able to buy high-growth stocks at a fraction of their previous costs. This liquidity allowed them to participate in the rapid recovery that followed, while those who were fully invested had to wait years just to break even. Maintaining a cash buffer ensures that you are never a forced seller and always a prepared buyer. It is your primary tool for turning a period of economic stress into a period of strategic acquisition. Identifying undervalued assets is the primary mechanism for generating wealth when the economy slows down. During a downturn, the market tends to punish all companies regardless of their individual strength, which creates a massive pricing inefficiency. This happens because institutional investors and retail traders alike often sell their holdings to raise cash, dragging down the prices of even the highest quality businesses. Look at the technology sector during the early 2000s, where even the strongest companies saw their valuations slashed by 80% despite maintaining healthy balance sheets. Smart investors who recognized that these companies were still dominant in their fields were able to buy shares at extreme discounts and ride the wave of the digital revolution. You should focus on finding companies with low debt, strong cash flow, and a competitive advantage that will allow them to survive the storm. Buying quality at a discount is the most reliable way to ensure long-term capital appreciation. One of the most effective ways to manufacture returns during a flat or declining market is through the power of dividend reinvestment. When stock prices are low, your fixed dividend payments actually buy more shares than they would in a booming market. This compounding effect accelerates significantly during a downturn because you are accumulating a larger number of units at a lower cost basis. For example, if you own a utility company that pays a consistent dividend, that payment might buy 2 shares when the market is high, but could buy 3 or 4 shares when the market is low. When the economy eventually recovers and prices rise, you will have a much larger total position than if you had simply held the original shares. This strategy transforms market volatility into a fuel for your portfolio growth over time. It creates a passive accumulation machine that works hardest when the outlook seems the most bleak. Consistently reinvesting your yield ensures that you are always expanding your ownership in productive assets. A sophisticated way to protect your capital and even profit during a decline is to allocate a portion of your portfolio to defensive sectors. These are industries that provide essential goods and services that people cannot live without, regardless of the state of the economy. These sectors typically include healthcare, utilities, and consumer staples because demand for medicine and basic groceries remains relatively constant. Think about a company like Procter & Gamble, which produces household necessities. Even if the stock market is crashing, people are still buying toothpaste and laundry detergent, which keeps the company earnings stable and its stock price resilient. By shifting your focus toward these sectors, you reduce the overall volatility of your portfolio while still collecting dividends and maintaining exposure to the market. Defensive investing is not about avoiding risk entirely, but about managing it by choosing businesses with inelastic demand. This approach provides a psychological and financial safety net that allows you to stay invested when things get difficult. Real estate offers some of the most lucrative opportunities for wealth creation during a financial downturn, especially through the acquisition of distressed properties. When interest rates rise or the economy enters a recession, many property owners find themselves unable to maintain their mortgage payments or keep their buildings occupied. This leads to a surge in foreclosures and motivated sellers who are willing to offload assets for significantly less than their replacement cost. During the housing market crash of 2010, many investors moved away from stocks and into single-family rentals that were being sold at 50 cents on the dollar. Those who bought during that time secured low-cost bases and benefited from both rental income and massive price appreciation over the next decade. You can find similar value today by looking for commercial or residential properties where the current owner is under financial pressure. Real estate allows you to use leverage to amplify your returns on assets that are inherently tangible and scarce. Focusing on distressed real estate is a proven path to building a high cash flow portfolio. The acquisition of small businesses is a frequently overlooked method for making money during an economic contraction. Many business owners who are nearing retirement may decide that they do not want to navigate another recession and will choose to sell their companies at attractive valuations. Because there are fewer buyers with available credit during a downturn, you can often negotiate favorable terms such as seller financing. Imagine finding a local plumbing company or a specialized manufacturing firm where the owner is ready to exit. You could potentially buy that cash-flowing entity for a multiple of 3 times earnings rather than the much higher multiples seen during economic peaks. By applying better technology or marketing to an existing business, you can increase its profitability even as the broader economy struggles. This strategy gives you direct control over your income rather than relying on the whims of the public stock market. Buying a boring but essential business is one of the most stable ways to build wealth. If you have a higher risk tolerance, you can use short selling or inverse exchange traded funds to profit directly from falling prices. While traditional investing focuses on buying low and selling high, these tools allow you to profit when an asset loses value. This is beneficial because markets often fall much faster than they rise, allowing for rapid gains during periods of high volatility. For instance, an investor who held an inverse EF that tracked the inverse of the S&P 500 would have seen their position increase in value during the sharp declines of 2022. It is important to remember that this is a tactical move rather than a long-term strategy, as the stock market tends to rise over the long run. However, using a small portion of your portfolio to hedge against downside risk can offset losses in your long-term holdings. Mastering these tools gives you the ability to make money regardless of which direction the market is moving. It turns market crashes into a source of potential profit rather than just a source of pain. Tax loss harvesting is a powerful way to use a financial downturn to your advantage by reducing your overall tax liability. This involves selling investments that are currently at a loss to offset the capital gains you have realized elsewhere in your portfolio. This strategy is effective because it allows you to keep more of your money in your pocket rather than giving it to the government, which essentially increases your net return. Suppose you have a stock that has declined by $10,000. By selling that position, you can use that loss to cancel out $10,000 in gains from a different investment you sold earlier in the year. If your losses exceed your gains, you can even use a portion of that loss to offset your regular income tax. After selling, you can then reinvest the proceeds into a similar but not identical asset to maintain your market exposure. This proactive management of your tax situation is a hallmark of professional wealth management. It ensures that every market movement, even a negative one, serves a strategic purpose in your financial plan. One of the best investments you can make during a downturn is in your own human capital through upskilling and education. During a recession, the job market becomes highly competitive, and those with specialized or high-demand skills are the ones who remain employed and command the highest salaries. Investing in yourself has a guaranteed return because your knowledge and abilities cannot be taken away by a market crash or a bank failure. Consider a professional who uses a period of economic slowdown to earn a certification in artificial intelligence or advanced financial analysis. This individual becomes much more valuable to their current employer or more attractive to new ones, leading to higher lifetime earnings that far outweigh the initial cost of the course. By increasing your earning potential, you provide yourself with more capital to invest in the very undervalued assets we have discussed. Your ability to generate income is your greatest wealth-building tool. Focus on becoming so valuable that the market cannot afford to ignore you, regardless of the economic climate. Hedging your portfolio with precious metals or commodities can provide a crucial buffer when traditional financial assets are declining. During times of high inflation or geopolitical uncertainty, gold and silver often act as a store of value because they cannot be printed by central banks. This is important because it provides a form of insurance against the devaluation of paper currency and the volatility of the stock market. For example, during the stagflationary period of the 1970s, while stocks were essentially flat for a decade, the price of gold saw massive increases as investors sought safety. Adding a small allocation to physical gold or commodity producers can stabilize your total portfolio value when everything else is in the red. These assets often have a low correlation with stocks, meaning they might move up when the market moves down. While they do not typically produce cash flow, their role as a diversifier is unmatched during periods of systemic economic stress. Using commodities as a hedge ensures that your purchasing power remains intact even if the local currency weakens. Utilizing dollar-cost averaging is the most disciplined way to build wealth without needing to perfectly time the bottom of a market. This strategy involves investing a fixed amount of money at regular intervals, regardless of whether the price is up or down. This works because it forces you to buy more shares when prices are low and fewer shares when prices are high, which naturally lowers your average cost per share over time. Imagine an investor who puts $1,000 into an index fund every single month. During a market downturn, that same $1,000 might buy 20% more shares than it did the month before. By the time the market reaches a new all-time high, the shares bought during the depths of the recession will have seen the greatest percentage of growth. This removes the emotional stress of trying to guess when the market has hit its lowest point. Consistency is the key to capturing the full recovery of any economic cycle. Stick to your plan and let the math do the heavy lifting for your long-term success. Making money in a financial downturn is not about luck, but about having a clear strategy and the discipline to execute it. We have covered the importance of maintaining a cash reserve, identifying undervalued stocks, and the power of reinvesting dividends. We also explored how defensive sectors, distressed real estate, and business acquisitions can provide stability and growth. Remember that tax loss harvesting and upskilling are essential tools for maximizing your net worth over the long run. By combining these methods, you can transform a period of economic uncertainty into a period of massive personal growth and financial gain. The key is to stay rational when the world is emotional and to keep your eyes on the long-term horizon. If you found this deep dive into recession-proofing your finances helpful, please hit the like button and subscribe to our channel for more high-end financial education. We would love to hear from you in the comments, so please tell us which of these strategies you are currently using to prepare your portfolio for the next market cycle. Thank you for watching.